You touched on it. You and I have both been doing this for over 2 decades, so we went through the different market shifts.
Sure.
But I say the same thing. There's a lot of people that are panicked when they don't get multiple showings and multiple offers, and they're on the market for 45, 50, 60 days, and they're starting to panic. A normal market, as you already said, is 90 days.
Yeah.
I would like to take a 10-minute break and then 3, 2, 1. How do you have the ability to analyze stock?
Welcome to the Generations of Wealth podcast. I am your host, Derek Dombeck, and today's show, just like every show, I tell you every week, fantastic guest and also a personal friend of mine. So we're going to dive into note investing, but a little different angle than you probably typically hear. Before that, I just really appreciate you being here. And I try to tell you every week, use the Generations of Wealth platform, use us to build your network, to get connected. If you need something or you need help with anything, don't hesitate to reach out. DerekDombeck.com or thegenerationsofwealth.com. So let's just get on with the guest and I'll stop rambling. Here we go. And here he is, all the way from Indiana, my friend, Jay Redding. Jay, thank you so much for being on the Generations of Wealth show.
Well, thank you so much, Derek. Appreciate the opportunity, and hopefully your listeners will be able to gain a few key pearls out of our discussion today. That'd be fantastic.
Well, I have no doubt they will. Before I ask you to tell the world about yourself, so just a little background. Jay and I are in a mastermind together, so we've gotten to know each other quite well and intimately, whether we like it or not, through the whole mastermind atmosphere. And, one of the reasons I really wanted to bring Jay on the show is just because he's got a completely different angle on note and note investing than what you typically would hear on podcasts. So with that, Jay, why don't you just give a little background on how you came to be?
Sure, sounds good. Just for everybody's background, I did my first real estate deal in 2004. Been full time since 2007. We've completed over 100 fix and flips. We had 4 or 5 rehabs going at a time at one point. Out of that game, haven't done those now for 2 years now, maybe 3 years even. Haven't done a fix and flip. Margins got tighter, and I'm getting older, and that plays a factor in the ball game. We had as many as 45 rentals. We're down to 38. We've purchased a number of tax liens over the years as well, and that's kind of did some private lending, IRA investing. I've done a lot of stuff on the self-directed IRA stuff. Both on the Roth side and as well as on traditional, and we've done some transactional funding. And when I first got started, I did some wholesaling, maybe 50, 60 deals, not huge. All right, I didn't have a big crew or anything like that. That was early on in my career. It served a purpose at the time. Hats off to all you guys out there that do it. I hated it. Okay, I'm just going to be honest. All right, so. And then got involved in notes in 2019. My son-in-law and I, Kyle, we run our business together. All of our rentals are within 30 minutes of our office. All right, and that's designed specifically that way. And we kind of, as we were discussing, as the next generation, you talk about generations of wealth. I have one child. I have a daughter. Kyle's married to her. Obviously, I have 2 great grandsons. And as all of this transitions into the next generation, it's like, okay, what do you have an interest in? Those types of things. It's like he runs pretty much everything on the real estate side right now, and he says, I don't want to manage rentals for the rest of my life. So, and I got it. I get it. So he's actually the one that got us more interested into the notes, and then we started really doing some digging and involved with some masterminds out there. We're involved with Note School, all right, through Eddie Speed. We're also involved with Fred and Tracy Brewery, all right, who all of them have 30 plus years in the note business, so they're very seasoned, and those are basically our mentors, is what it basically is. So that's kind of where we're at now. We buy notes, all right. We buy performing and non-performing. Our focus primarily because of just the markets. We have aligned ourselves. We've worked hard to align ourselves with individuals that are house buyers that can be fix and flippers. They can be rentals. They turn around and sell on terms to other investors or to owner occupants, either way. And we actually have become kind of the bank for them to help recapitalize them. So we can get into more of that type of discussion, how that works, what that looks like, those types of things, because I think it's a lot of real estate investors. Number one, they don't know how to create a good note. They don't know what note buyers are looking for. Okay, number one. And number two is that they don't know how to create a good note, to structure it right so that they don't have to take a huge discount, and structuring the deal correctly so that they can get recapitalized and go do another deal and not have to give up the whole deal. That's the thing. Too many people are having to give up the whole deal because they didn't structure it right to begin with. So we can help in that respect.
Well, we're definitely going to dive very deep into that type of stuff, Jay, because again, that's something that, especially in the changing markets, we get house flippers. You got out of flipping houses for a reason. I'm trying to not do a whole lot of rehabs myself anymore either. And number one, we're in a different market, and you can make money flipping houses in any market. It's all on how you buy. But having that extra exit strategy of creating a note, selling on terms, and being able to offload that note is not something that very many people consider, let alone know how to do properly, as you already said.
Right,
So,
exactly.
But let's talk about the market first, because you said it kind of as you were introducing yourself. You kind of got out of flipping. Yeah, you didn't want to do it because you're not getting any younger, but you're still a puppy in regards to your energy level and what you can do and what you want to do. I mean, I know you personally, so it's not like you're not going out there and wanting to hustle, but the margins on flipping changed and
much thinner.
Changed.
Yeah,
so,
much thinner.
So what led you to make the decision to not flip at all? And I know Kyle kind of was the first one to look at the notes, but what led you specifically to want to work with people that are flippers, selling on terms, and then helping them with their notes?
Okay, sure. The first thing is, as you well know, Derek, this is a common. You need to be if you're going to do fix and flips, you've got to be all in at 70% of the after repair value. I mean, that's been a standard for years. And as the values have increased and the margins, honestly, I've never purchased that many homes from wholesalers. All right, not to knock wholesalers, but the ones around here are too greedy. Okay, and it's like, you don't leave enough meat on the bone so that I have a margin to make a good profit. I'm not down to do business with you. Okay, and I think a lot of wholesalers have missed that boat. Okay, they've not done a good job necessarily in knowing what the rehab costs are. So I mean, if you're purchasing and rehabbing, and you're all in at $200,000 and you're making $25,000-$30,000 profit, that doesn't make sense. You got to make a net 20 minimum net profit to stay in the game on the long term. And I just started seeing those margins getting
20%, not 20,000, to be clear.
No, 20%. Yes, right. Exactly right. Thank you. 20% net margins. All right, to be able to stay in the game. And it's like, I kept seeing those getting tighter and tighter and tighter, and you don't have errors for making mistakes. And when have you ever done a rehab when something didn't go, according to plan? Okay, It's just normal, even when you factor it in. And the cost and the labor and everything's gotten higher, and it's just like, this doesn't make sense anymore. And it's just like, we shut it down. Now, will we? Okay, I say that. Now, if a really good deal comes to my, comes in my lap, I'm not going to turn it down. Okay. But it's not a focus of hunting out there trying to find those deals. That's right. So, yeah. So that's why.
And then going into, helping people now, creating notes to like a flipper that can't sell their house, or they're not able to sell their house the way they thought they might be able to. How did you transition into that?
Okay. When you're looking at creating a note, well, we just kind of got into the note, learning the note space. It took us a year or so to kind of learn the note space, the ins and outs, and really to get our toe in the water. I mean, I used some of my IRA money to kind of buy some of the first notes, and then started thinking about, okay, how do we make a business model out of this and everything? And it's like, and that's when the market was starting to shift. All right, when markets were shifting, and it's like, okay, days on market starting to increase and all that type of stuff. And I guess you got thinking, it's like, okay, these guys are having to that are seller financing. Some, there are real estate investors that do seller financing. You typically see a couple different scenarios. The fix and flipper is one scenario, okay, but you also have the wholesalers, or also, I'll just say house buyers, all of them, okay. They do a couple different things. All right, they have a house buyers that will buy a property. Okay, it's a decent property. All right, it's in a working class neighborhood. They can turn around and seller finance that immediately to a non-QEM, and we're not going to get into all the details of all that. We don't need that for this. But basically, someone who doesn't necessarily qualify for a bank loan, but they make good income, all right, and have a decent down payment. They'll sell that property to them in pretty much as is and make their margin, and that's perfectly fine. But now they've got a 20 or a 30-year note. Now what do you do? Mm-hmm. Okay, they may have used a private lender, all right, to take down that property, all right, to begin with, and turn around and sell. They've made their margin. And if they've got a large down payment on top of that, they've got their spread, their profit spread, plus they've got their down payment margin. And now when I'm saying good down payment, I'm talking nothing less than 10%. The guys that we're buying from, they're finding buyers are putting between 10 and 20% as a down payment. And most of the time, those are in the Latino markets is where that is at. Not all, okay, but often that is the case. And they're typically contractors. They're typically business owners. And okay, if a smart business owner, all right, isn't going to show that much profit. We all know that, Derek. We're going to try to do as much write-offs as possible. Mm-hmm. Well, that makes it difficult then for them to get a bank loan, is what it is. But yet they make good income. You can document their income. They got a good down payment. They're good quality candidates. And there's techniques and ways of going about that to document all of that. And we're not going to necessarily get into all that. That's a whole nother discussion by itself. But the concept is, all right, now you've got a good performing note. You let it season for a little bit. We'll come in and we will essentially do what's called a partial, which is a partial by definition is nothing more than we're buying a certain number of payments for a certain period of time. So we talk with the real estate investor. They want to get their money out so they can go do another deal. We'll talk to them, all right, what do you need out of it and still make a little bit of profit? Because they're not looking at doing this, obviously, without making any profit at all. Mm-hmm. But they're not necessarily getting all of their profit right now. And we'll talk to them of what that is, and we will not go any higher than 70% of the actual value of the property as it is right now. That's as high as we will go, because we need to build in an equity cushion protection for us. That's what we have to do. And then we'll determine if they give us an idea of where they need to be to get their private lender out. Obviously, the private lender has to be paid off whenever we do the closing. That puts us then in the first lien position, which is where we want to be. They've got their money. They go do another deal, and they still have a number of payments that's still due to them on the back end. And that those payments are protected. Even if the borrower pays off early, whatever that unpaid principal balance is that's entitled, or it's called the remainderment, okay, to the real estate investor, that amount is protected. And if they pay off early, we as the partial owner get paid off first, and then the remainderment gets paid then to the real estate investor. And if the borrower continues to pay, say we buy 10 years worth of payments, they pay through 10 years, and then that note reverts back to the real estate investor, and they continue to pay all the way to the end. They've just made continued interest on top of that. That's what they've done. And they'll make 30 to 40% more, okay, than if they would just taken the profit on the flip. And that's how you generate long-term generational wealth over time and still making some profit now. Okay, so that's how we help them to create a better note, help people, teach them how to underwrite the borrowers to make sure they get a good buyer in there. And then what we as note investors, what we want to see, where those interest rates need to be, those types of things, and the type of discount that they'll have to take, but we can help them structure it ahead of time. Mm-hmm. Once you cook the pie, we can't do a whole lot at that point. If you come to us beforehand, we can help you create the ingredients to make a better pie. That's what we're trying to do.
Absolutely.
Yeah.
So, I mean, I know it's deal specific.
Sure.
But let's just talk about maybe an average transaction that you've done, interest rate, discount that the
Sure.
the real estate investor would have to take. Put some numbers to it.
Yeah. All right. Well, first of all, if you're selling this at an interest rate of 6 or 7, you're going to take a huge discount. Don't do that. Okay. Most note investors are wanting at least a 10. People that we are buying from are they are selling at 11, 12, 13%. That's kind of where they're at. Okay. And the notes are typically, the terms are usually 240 months to 360. Okay. But it basically runs from 180 to 240 is where the majority of them. So you're looking at 11 to 12% interest rate. Now, depending upon what state you're in, you need to make sure what your usury laws are in that state. We're buying out of Indiana, and we're buying primarily out of Indiana and also Texas. Those are the two states that we're purchasing from it, but we will consider some other states as well. And we do have notes in other states, but those are our two primary areas. So we're not running into any problems as far as usury there. But say 12%. All right. Indiana, we're in the working class neighborhoods. They're probably selling a house in as-is condition anywhere from 120 to 140,000. All right, that's your working class neighborhood here. Texas, it's a little bit higher. Working class neighborhood there is probably in that 150 range to 180 range. If it's a mobile home on land, and the mobile home titles have been decommissioned so that it's treated as real estate, that's probably that's in that 180 range, okay, depending on the quality of the mobile home and the age in that respect. That's often, that happens a lot in Texas, okay. So if the house buyer has done their job correctly, I mean, obviously they've negotiated a price when they purchased the home, and they probably have they have a built-in spread. I don't know what that spread is, okay? But what we try to do is, what we have been basically doing is that they will get a 15 to 20,000, 25,000 down payment, okay? Particularly in that 140, 150 range. So they're getting 10 to 15% down payment pretty routinely. They'll do a 12% interest rate, big payments, and taxes and insurance are escrowed, and they close with the title company. They do owner's title policy. They provide lender's title policy, and then they place it with a licensed servicing company for that state. That's really important. Most people they're not aware of that. Why is that important? There are a whole host of laws, okay, that I don't want to get into is being a debt collector, because now you're a debt collector. You own that mortgage is what you do, or deed of trust, depending on the state. And so now you're a debt collector, and there are a number of rules and regulations that you have to follow. We don't service any of our notes. We place them all with licensed servicing companies, and we manage the servicing companies is what we do. They do the day-to-day work to make sure everything is compliant. And that's really important. And they also document the payments, collect the payments, all that type of stuff.
Do you pass that cost on to the borrower?
Well, that is the great question, and this is what rookies don't understand. Okay, a common monthly fee is about $35 for most of our licensed service companies, and yes, that is built right into the terms that the borrower pays that on a monthly basis. If not, you're going to take a deeper discount because we're going to factor that into our monthly price. All right. As far as purchasing the loan, because that's $35 that we have to pay out. And as a result, that can change a note purchase price significantly, quite honestly, over when you calculate out for 20 or 30 years.
Absolutely.
So, great question. Escrow is really important as well. Escrowing taxes and insurance, critically important. And if you place it with the servicer and you're closing through your title company and everything, we typically ask for 2 months, just like a bank, typically 2 months as far as funding the escrow account for taxes and insurance. And we ask that a year's worth of insurance be paid up on the home itself. So homeowner's insurance.
So assuming that this note is drafted correctly, note and mortgage or deed of trust, how long do you like to see it season before it's saleable to a note buyer?
Excuse me. Great question. What we basically like to see, we want to see a minimum of 3. If we're working with you initially, we're going to want at least 6 months of on-time, absolutely perfect payments. Okay. Ideally, if you can get it set up on ACH, that's perfect. All right. That makes it even better. Once we get a working relationship with you and we're comfortable with how you're underwriting the borrowers and all of that, and they're doing the RMLO so that we can see the documentation that's there, we will buy it about 3 months then at that point. We just want to make sure everything gets situated is what we do, and that they're on board on where everything needs to go. We're typically not going to change the servicing company, particularly if it's with one of the 3 that we primarily work with.
And does the borrower's credit score affect what you're willing to pay for the note?
We do not place as much emphasis on credit score because, quite honestly, a lot of these borrowers in this type of scenario in the Latino community do not have credit scores, okay, because they work everything with cash. So if we can get a credit score, yes, all right, we will look closely at what's on that credit score, all right. But do we make our decision exclusive on the credit score? Absolutely not. It's only one factor in many that we look at.
So if the investor, house flipper, if they were trying to get a 20% profit, net profit on a $200,000 house, they would have been attempting to get $40,000 of profit.
Sure.
If they had hard money in place, then they're probably paying 12% or more and 3 points and all the fun stuff. And they get to the point where the house is not selling. They're really not, by the time they sell at a discount, they're not really going to get their $40,000 or much of it today, but they'll get the hard money lender off their back.
Correct.
Not end up getting foreclosed upon and losing everything.
Correct.
Keep their relationships strong and solid with that hard money lender because they performed, so they can go on and do their next deal, right?
Correct.
And get a yield down the road on their $40,000 in that example.
That is correct. You know, time, Derek, as we both know, time heals a lot of wounds. All right, a lot of mistakes. If you can get out of it and you can claim yourself out of the situation over time if you structure things correctly. I fixed and flipped all during the Great Recession. Okay, so I know what it's like when the market shifts on you. And our holding times went from, well, our average hold during that period of time from purchase, rehab, and finally selling was 8 months. That was our average. Okay. Mm-hmm. Everybody gets all bent out of shape right now if it's 90 days. I mean, my gosh, that's a normal market, 90 to 120 days. And mm-hmm. It's like a lot of people that's in the market right now, they've never experienced that. And what I would tell you is that, particularly if you're using private capital, we never went the hard money route. I had all private capital. That's what I basically did. Okay. And I structured my private capital so that I had that for 2 years. Okay. It was an automatic year, and then with the ability to renew for 1 more year, because I only went over a year, I think 1 or 2 times, and it was just barely over a year from the time that we purchased, rehab, and sold the property. So even in tight markets, there's still transactions taking place and everything, but you got to make sure that you have your financing right to protect you for a long hold time. And again, if you don't have large margins, that's going to be hard to do.
Yeah, absolutely. And you touched on it. You and I have both been doing this for, over 2 decades. So we went through the different market shifts.
Sure.
But I say the same thing. There's a lot of people that are panicked when they don't get multiple showings and multiple offers, and they're on the market for 45, 50, 60 days, and they're starting to panic. A normal market, as you already said, is 90 days.
Yeah, it is.
We're still in a seller's market by those mm-hmm. standards.
Right.
And there is still in parts of the country an inventory shortage, which some people, like to say, well, the market's not bad where I live. Well, no, everything's different depending on where you are. But there's parts of Florida and Texas, and you can't give away a house right now.
That is very true. It's all local specifics of what's taking place. And you have to be knowledgeable of what's happening in your market and have your finger on the pulse, and you better have a relationship with a good realtor that tracks those days for you and giving you reports on a consistent basis. I had one of those. Okay. So that when we were doing a lot of that, so I knew what was happening and what to expect. And when that market you're starting to see when that shift is starting to take place.
Where do you find somebody like yourself if it's not in your backyard? I mean, you're not in everybody's backyard, obviously. No. So what's the best way to go start relationships with note buyers to know what the note buyer is willing to pay so you can structure the notes accordingly so they're saleable?
Sure. All right. We primarily buy in 8 states is what we buy in. Okay. So a note buyer, I mean, there's note buyers on bigger pockets. All right. And here's the thing that you got to realize. Every note buyer is looking for something different. Okay, so if you run across one that he's just not a fit, or they're not a fit, or whatever in that respect, that's okay. Keep searching. There is a couple platforms out there where you can put your note. All right, I just went blank, Derek. I'll think it's my old age creeping in on me here. You can reach out to Colonial Funding Group. They buy notes. We buy notes. Okay. We host a note talks. It's just called Note Talks with Con J on the last Thursday of every month. And it's no cost for that. We share things that we're working on. It's a great place to ask questions. Hey, I'm looking at selling this property. This is what we're kind of looking at. I can ask you questions. How do you pre-qualify your buyers? I will direct you to Dan Deppen at calltheunderwriter.com. All right, right on his website, he's got a list of preliminary questions that you should be asking your potential buyer to do a preliminary discussion with them to make sure that they're a potential candidate for you, because there's a lot of tire kickers out there, Derek, you know that. So just to weed through that before you submit stuff to he's an RMLO, residential mortgage loan originator, to do the underwriting on the loan. Now remember, he's only doing the underwriting and giving the disclosures and documenting the amount of their income so that they meet the Dodd-Frank requirements for the ability to repay the loan. You, as the seller of the house, you're the decision maker. I mean, I have seen RML underwritten loans which had a debt to income ratio of 57%. Okay. The Dodd-Frank rules do not state what percentage. I mean, I can assure you that loan is not going to perform long-term at 57% DTI. No way. Derek, you'll attest to that as well.
Absolutely.
So we look, we'll go as high as 45, but quite honestly, we prefer to be around 40, okay, as our top limit, is what we kind of like to see. So that helps give you some guidelines there. And the platform, I did think of it, the platform that you go to is PaperStack. There you go, to sell your note.
Okay.
Paperstack.com. Duh. I mean, I know those guys really well. I can't imagine why I couldn't think of that. But yeah, you can, that is a note trading platform. It's out there right now. So.
Well, and if nothing else, just go there and browse around and see what's being offered for sale, and
Sure,
learn the lingo, so to speak.
Yeah. Learn the lingo. You can do it with you'll learn the lingo of what we talk about with our note talks. All right, it's 12 to 1 Eastern time is when we do that on the last Thursday of the month. And then once you start poking around, you'll start finding other people who will buy notes. Okay. So.
Well, and the low-hanging fruit is also just getting involved in your local network, whether it's your RIA or whatever.
Absolutely.
And start asking around if there is anybody that is a note buyer or would consider buying notes. That's something that the whole point of whether it's podcasting or masterminds or RIAs or whatever is to build your network. So if I have a challenge and I want to find a note buyer, obviously I can call Jay, and Jay knows lots of people in that market, right?
That I do. I can give you probably 4 or 5 different places that you can go to and see if they might be interested in addition to ourselves. I mean, we don't buy everything that comes to us by no means, but I know the major players that are out there, and I kind of know I can direct you to kind of the right area to go and talk to. And most of the time, you don't have to sell the whole note. That's the thing. So many times, people think they've got to sell the whole note, and then if they've created a poor note, they're just going to get hammered on the discount. So it's going to happen.
And that's probably something we should touch on just for a minute is yield versus discount, because we talked about rates and what things are sold at, but maybe dumb that down just a touch.
Sure. A discount is you're dealing with the secondary market here as far as notes are concerned. None of these notes are Wall Street grade notes. Okay. And so therefore you're not going to get paid par. On Wall Street, they'll pay par, which is whatever the unpaid principal balance is and the current interest rate. And sometimes even slightly above. And I've had people that's come to me and say, hey, this is a great note, et cetera, et cetera. We're not taking anything less than par. And I said, well, if you want par, then take it to Wall Street. Okay. And if it won't go to Wall Street, then come back to me. If it's not Wall Street grade, don't talk to me about par, because I'm not going to pay par. Mm-hmm. Okay. It's just that simple, because you don't have everything in place that puts it to that level. So sorry, that's just kind of my soapbox there for a moment.
Absolutely.
Well, but there is a discount that you're calculating risk in here. Okay. And there's about 6 things that we look at as far as grading a note. And I have them right on my wall here. So I make sure I don't miss anything, but I'll just cover it. Obviously, the buyer is one, and none of these is a hard and fast rule. It's a grade, okay? There's redeeming and non-redeeming factors in this. Perfect example would be someone brings a note to me and the borrower only put 5% down. All right. That is a non-redeeming factor. And it wasn't RMLO'd, okay? But the borrower has paid for 10 years now on time. That's a redeeming factor that kicks out the non-redeeming factor initially. So we've got 10 years of payments that's showing that they can document by third-party documentation that they have paid on time. Whatever their situation was when they started, they obviously make the payment of their mortgage a very high priority in their household. That's a huge redeeming factor, okay? And I would not view that as being a negative, okay, at all. And actually, past history, although it's not totally predictive of what's future, but it's a good predictor of habits is what it is. Mm-hmm. And that's what we're trying to find. What are we seeing as far as habits? What are we seeing as tendencies? All right. And that's where you're looking at the redeeming, non-redeeming, the grading of the note per se. Another thing is, how good is the collateral? Is the collateral a piece of crap? Okay. Or is it kind of does it have flowers in the garden in the front? Are they taking care of it? Maybe it's not perfect, okay? All right. But it's their castle. We may not live in it, but it's their castle, okay? And is it being treated as a homeowner? Now, the other thing is we'll see a note on a property that you can see that the roof is at the end of its lifespan, or someone's been they've been in this home for 3 years and it doesn't look like anything has been picked up. Well, the value of that asset, which is the ultimate backstop to our risk, if that house would come back to us, I have to answer the question, could I turn around and sell that at the sheriff's sale, all right, and get my money out, or my private lender's money out? And many times they're upside down. Okay, there's just not enough cushion in there to protect us. So those are the types of questions we're looking at. You know, what's the buyer's equity into the deal? What's their skin in the game? If they're putting $30,000 down up front, they've got some skin in the game. That's why we may not need to have as long a seasoning to buy the note, because they've got significant skin in the game. Now, equity is gained over time by monthly payments, and equity is also gained by the market. So we have to evaluate, okay, the house may be worth $170,000, but they've only paid maybe 6 months on this. What's their true equity and what's their true skin in the game? Is it really worth taking that risk? Those are the things that we're trying to determine. All right. You know, is the paperwork, is the note created well? Okay. Interest rate, is it right? Is it being serviced by a third party? Licensed servicer? Is it escrow for taxes and insurance? Who pays the servicing fee? You know, is there a performing note? Is there a 15-day grace period, which is fine? Is there a default interest rate? Is there a late fee that's built into it? I saw a note that had no attorney clause in it that you can collect your attorney fees. Wow. Okay. All right. That's just, okay. Good luck selling that one. That one's never going to sell. Mm-hmm. All right. So, and those are the things that you have to have in your documents. Okay. And again, we can help you and guide you there. And what's the terms of the loan? Okay. Is it a 360? I saw a loan not too long ago. It was 480 months. Okay. Crazy. Yeah. All right. That borrower is paying virtually nothing down on principal. It might as well just be an interest-only loan. Is what it basically be. I've seen loans with no interest at all. What do you think the discount's going to be on that one? About 80%. Mm-hmm. Okay. So if you do all the right things, you can sell a note at 92% of unpaid principal balance. That's not uncommon. Maybe as high as 95, all right, depending on collateral. But if you do it right, 90 to 95 is not an uncommon or unreasonable expectation. Okay. If you do it poorly, you're looking in 70% range.
Okay.
Okay. Is what you're kind of looking at. So hopefully that's helpful.
No, absolutely. Absolutely. Well, Jay, I am going to hit you with the hardest question of all, and my regular listeners know this. What is one question I should have asked you that I did not? And it can be about anything.
Okay. Well, there's one question. Let's see here.
And you can't talk about anything with me at Masterminds.
Oh, okay. All right. Well, man, that narrows it down there, because that would leave it wide open there otherwise. I'm going to say, well, you didn't ask me how they can get a hold of me.
Well, then hit it.
Okay.
There it is.
All right. If you want to reach out, I would direct you to our website, and that website is Cassidy at CASSIDY investments.com. You can sign up for our quarterly newsletter there. You can sign up for the note talks. All right. No cost for anything. We have a lot of educational stuff that's on that website as well. Let's just make it available. Our goal is to help you create better notes. Our goal is to help you to move seller financing higher up in your disposition strategy. Okay. Because Derek, you and I both know you're not going to want to flip your entire life. There's going to be a point where you want to flip and where you want to start to pull back. It's a grind. There's nothing wrong with a grind, but it is a grind. Mm-hmm. Okay. Been there, done that. All right. In the past, it's always been rentals. That's been the cash flow, the Burr method, everything else. I will tell you right now, with what's going on in the rental space, all right, notes are going to cash flow approximately 2 to 2.5 times more than what a rental will right now. If you look at your net returns, okay, your net returns, I'm going to guess you're probably around 4 to 5%. That's what we're seeing across the country. Do you really want to be dealing with everything on the rentals for 4.5% return? Now, you got some great equity, okay, because equity has gone. Your return on equity sucks right now, okay, for everybody, ours included. So I'm not poking the bear here. It is a result of what's happening in the market. I would tell you this: if you've got a number of rentals, this is the time to really look at your portfolio and consider selling some of those on seller financing. I call it culling the herd. I grew up on a farm, and if you're a country kid as I am, I grew up on a hog and dairy farm. So what that means is that you get rid of the poor performers, the genetic poor performers, that type of thing, as far as the farmer is concerned. Take a look at your portfolio. Do you have a couple rentals that just haven't performed as well for a number of years as they should? Those might be the targets to be able to sell on seller financing and get a lot more cash flow, particularly if you're hurting on cash flow from the rental standpoint. That could be a strategy. We've done that a little bit ourselves, okay? And it's made the 2.5 times is exactly right. Yeah. Plus, your capital gains you get to spread out over time. That's from the tax advantage. Now, you got to have your depreciation recapture tax. You got to pay that in the first year. But your capital gains, your equity that you have in that deal, you get to pay that out as interest payments come in. So,
well, I love it, Jay. Number one, I appreciate you being here. Being in a mastermind together, we as I mentioned earlier, we know a lot about each other, but I also know you and your son-in-law Kyle, salt of the earth, just heart-centered, willing to give your time like this. And again, anybody that wants to reach out to Jay, by all means. And if for any reason you're listening to this in the future and for some reason you can't get a hold of him, let me know. I will get you connected with Jay. So,
Yeah.
so thank you.
Thank you. I appreciate the opportunity. Hopefully we've been able to help. All right. And maybe we'll buy some notes from you down the road. Who knows?
Absolutely.
You never know.
Absolutely. Well, we'll wrap it up here for all of you listening. Thank you so much for being here as always. Please go out and share this show with anybody that you know or you believe this can help. Give us all the love on social media and everywhere else and help us grow the generations of wealth. And until the next one, go out, live your vision, and love your life. See ya.
All right. Catch you later.